Hello and welcome to Sprott CE Credit video on real assets. For today's video, we will be covering the value of precious metals with a focus on gold and silver, as well as exploring the opportunities in critical materials such as copper and uranium. My name is Ed Coyne and I'll be your host today for this 50-minute CE Credit class on real assets. I've asked Ryan McIntyre and Steve Schoffstall to also join me today. Ryan is a managing partner and senior portfolio manager at Sprott, and Steve is the director of ETF product management at Sprott. I've asked Ryan to address potential ways to help investors allocate to both gold and silver in building out a diversified portfolio. And then we'll turn to Steve to cover the mid to long-term outlooks on opportunities in both critical materials with a primary focus on copper and uranium. So with that, let's get started. Ryan, let's start with 2024. 2024 has been a wonderful year through early November in both gold and silver. What in your mind were some of the primary drivers behind that performance?
Yeah, no, gold and silver price have done pretty well so far in 2024. Silver and gold are both up approximately 30% year to date. And, the big drivers to me are really revolve around uncertainty in the world. And so you've got a lot of uncertainty in the geopolitical environment, whether you're talking about Ukraine and Russia, whether you're talking about things that are going on in the Gaza Strip, or even between China and Russia. And so you're seeing a lot of different political divisions that are really getting expressed through violent actions around the world, which is pretty unsettling to most people. And then the other aspect is uncertainty in the economy, right? You've seen a lot of different headwinds, particularly in Western Europe with manufacturing, the United States similarly, although the United States continues to plug along pretty well. But still, I think there's a lot of uncertainty in terms of where the economy is going in terms of direction. And, I think as a consequence of uncertainty, I think you've seen a lot of people start to look at diversifying their portfolio beyond just the standard, S&P 500, emerging market or international equities and standard kind of bond allocations. And, gold and silver, I think, really do fit the bill to add some great diversification to a portfolio. And it's, to me, no surprise that people have gone there.
Well, we're going to unpack that further, both on the economic side and the geopolitical side as we go through today's class. But I agree. We were seeing more and more capital move to this direction. So I'm looking forward to having a further conversation on that. Before we go into that, Steve, let's turn to critical materials for a moment. Both copper and uranium have had similar moves over the last couple years. What do you attribute those moves to as well?
Yeah, it really boils down to electricity, right? So if you look at where we're at from a global perspective, we've really gone through a period where most of the electricity demand was coming from developing nations, China, India, and some other developing countries. And we're actually starting to see now in the United States and other Western countries for the first time in a number of years where we're starting to see electricity demand increase. And if you were to look at it on a global basis, between about 2020 out through 2050, we're expecting to see around 165% increase in electricity demand. And when you step back and take a look at what's really driving that, when you start looking at developing nations, it's really starting to increase their standard of living. So India is a great example. You have about 97% of the households in India actually have electricity, but only 8% have air conditioning. It's just a small look at what's going on in developing countries. When you look at the electricity demand more broadly in the developing world, China needs somewhere around 600% more electricity is what their demand will be. India around 250%. When you juxtapose that with what we're seeing in Western countries and more developed countries, it's really about technological innovation. And the most recent place we're really starting to see that play out is as it relates to the data centers, particularly as they're supportive of artificial intelligence. Those data centers are massively energy intense endeavors, from running the complex data algorithms to cooling the data centers themselves. And what that's really causing is this renewed look at our overall energy output. And as that relates to nuclear energy, we're starting to see, particularly as it relates to Silicon Valley, they're really starting to embrace nuclear energy in a way that hasn't been the case previously. And one of the things that we look at is if you look at firms like Microsoft and Amazon, a lot of those companies have net zero emissions targets within their corporate mandates. So as they're building these data centers, they have to figure out a way to get clean energy or renewable energy to power the data centers. That's where they're starting to increasingly turn to nuclear energy because it does provide reliable baseload power. And it also is one of the cleanest energy sources, energy generation that we have. And just two examples of that, if you look at Amazon earlier this year, they actually bought a data center right next to a nuclear power plant in Pennsylvania. And just within the last several weeks, we're also seeing Microsoft enter talks with Constellation Energy to restart the 3 Mile Island nuclear reactor in Pennsylvania as well. Both of those are to power data centers. So as we go through the rest of this decade, we expect that to play out, and that's something that we expect to see, really contribute to the overall energy demand in the West.
Well, and I have to believe baseload applies to everybody, right? India and China, as they continue to grow, they need a 24/7 power source as well. They don't want their ACs cutting on and off as they get ACs in their house for the first time. So I have to believe that's the primary theme as it relates to energy, period, is the base load.
It is. And when you look at China specifically, if you look at the 440 or so nuclear reactors that are either scheduled to be built or planned to be built, most of those are in China. They're leading the way. Although the United States is the largest nuclear power in the world, China is looking to kind of move into that role. We do see, at certain conferences, if you go back to the COP28 conference around December of last year, we saw over 20 nations sign an agreement to triple nuclear energy capacity out through 2050. Wow. Coming outside of that, the UK actually came out and said, we're going to quadruple through 2050. That's what their goal is. So we've seen over the last several decades in the United States and the UK and many developed countries, the reliance on nuclear energy has decreased. We're now looking to return to those more historical norms, or in some cases surpass those norms as to how much it's contributing to the overall grid. The second piece that we have is not just around the energy that we need, but it's also transitioning from fossil fuels to cleaner energy sources. And with that, we're seeing governments increasingly embrace nuclear energy as that reliable baseload power alternative.
Well, and let's talk about that for a moment, because it seems like the narrative is just getting stronger and stronger. Going back to performance, the last couple of years have been strong, but it seems like a little bit of a pause or increased volatility has come into both the uranium market and to a lesser extent the copper market. Can you address that a little bit as well?
Yeah, let's take copper first, then we'll touch on uranium.
Okay.
So if you think of the copper market, a lot of that traditionally, since China started being industrialized, at the earlier part of this century, to a larger extent, that was driven by the economy of China. So as China's economy went, so too did the price of copper to a large extent. What we're seeing, if you go back to the early part of this century, back to 2000, the price of copper per ton was about $2,000 a ton, consequently that year. We're now, depending on the day, somewhere around $9,500 to $10,000 a ton. So we've seen a pretty consistent rise in the price of copper. This is in spite of the fact that the Chinese economy is struggling and they're trying to keep that economy moving along. A lot of what's really helping to support copper as it relates to China is their commitment to renewable energy and building out their electrical grid. So China is the largest buyer of copper, and they've continued to do that as their economy slowed down. As it relates to nuclear energy, similar type of narrative over the last 10 years or so. After the last 10 years where we bottomed the uranium prices, we've actually seen them peak up to about $106 a pound to start this year. We're now sitting in the high 70s to low 80s. Uranium market's a little bit different than what we see with other markets in that a lot of the uranium that's purchased is actually contracted into the future.
Okay.
So most of the activity isn't happening in the spot market. So it does give a somewhat different picture as to what's actually going on in the underlying market.
Great, thank you. And before we dig a little deeper into both gold and silver and copper and uranium, post-election, I think we have to at least comment on sort of the reaction in the markets. And I think I'd like to hear from both of you as far as post-election, what is your take on both gold and silver and on copper and uranium? Has the narrative changed at all? Has it paused? Has it enhanced? I want to get a sense from both of you what your thought is now that the election is behind us and we have the President-elect Trump coming back into office in 2025. So Ryan, let's start with you. How should potential investors continue to look at gold and silver now that we have a little bit more clarity, potentially clarity, in the marketplace, at least from a political standpoint?
Yeah, we got the question a lot, before the election. Now we know a little bit more about who's going to be in power and so forth. And I guess the key thing for us is it really doesn't change the way we think about gold or silver because we're thinking long term. And when you're trying to evaluate different circumstances, one of the best things you can do is actually think about things that aren't likely going to change. And so one of the things that we think is likely not going to change is the fiscal irresponsibility of the United States and other Western countries for that matter. But from our perspective, we're really on the border in terms of the fiscal responsibility now that markets can tolerate. And I think to me that's one thing that is definitely going to be continuing and definitely at the forefront, or will be at the forefront in terms of people's minds. But the one thing that has been consistent, with gold or silver, is their monetary properties in terms of protection against devaluing of the currency, in terms of debasement, so printing of money and so forth. And so as long as you believe inflation will continue to be positive, it should be very good for gold and silver prices long term. So I guess from our perspective, that does not change. And I guess the only other aspect as well that we're going to talk about is just on the geopolitical framework as well. It definitely feels like these divisions are getting wider and wider in terms of the trust factor, I would say, between the east and the western parts of the world. And I think that is very likely to continue as well, which should also be beneficial for both monetary metals, so gold and silver, just because I think that they'll be used more in the diversification mix of trade, investment as a safe haven. Because I think trust factor is probably, to me, one of the biggest things that's been eroding within the United States and external to the United States as well. And one of the few things that can protect against that, that's completely independent as an asset, is gold and silver, given it has monetary properties as well.
Yeah, well said. And Steve, we have to talk about this as well. Trump, at least on the surface, appears to be a little less supportive of the energy transition theme. How does copper and uranium go beyond that current narrative?
Yeah, and it's a great question. It's multifaceted, right? So each aspect of the energy transition or the critical materials space can be viewed differently, as it will react different, in our opinion, to the election. So first, if you were to look at things like electric vehicles, there's a common narrative that the next administration is going to come in heavy on electric vehicles, and that we'll see sales drastically drop. That's one of the narratives that's being floated out there. In actuality, assuming that what he said in the past as it relates to electric vehicles, the Trump administration will likely look for a bottom-up approach as it relates to EV demand. So getting the government, I guess, to pull back on the mandate side and let the market really bear out how the EV train is going to move forward. With that, we do expect to see plug-in hybrids will play an increasingly important role, as that's a great way to bridge consumers from an all gasoline powered car to all electric. You get the plug-in hybrid approach that's very much supportive of critical materials, because you still need a lot for that battery, a lot of copper, a lot of lithium, a lot of nickel in some cases. If you look at other aspects of the energy transition, another key piece is around the drilling aspect as it relates to natural gas, which is supportive of our view. Over the longer term, we expect to see an all-the-above approach as it relates to our energy consumption going forward. So that means things like nuclear energy, that means wind, that means solar, hydro, and natural gas. We've anticipated that being a part of the energy mix going forward. It's also important to remember that as we sit here today, the House and who controls the House isn't known, and it's likely whichever party controls the House is going to have a very slim margin. So it's going to be difficult, I think, for the next administration to come in and make these unilateral changes, even if the Republicans do end up winning the House. So that's something we'll have to keep an eye on. Another thing that is very supportive of nuclear in our view is, if you go back 15 or 20 years, the support for nuclear energy had largely been a Republican issue. That's changed a lot over the last 3 or 4 years, and the Biden administration has actually put a lot of incentives in place for the nuclear industry and to actually build out our nuclear industry. So those are things that Republicans are still supportive of, and we would expect that to carry through the next part of the administration. And then finally, as it relates to mining, all indications are that the next administration will be very much in favor of onshoring, that same process that's happened for the last 5 years or so, where we look to move supply chains away from China and away from other politically sensitive areas. We expect from a mining perspective that those incentives will continue to be there for miners to build out not only gold and silver mines, but as it relates to our energy and critical materials infrastructure, that'll stay here. And I guess one final point as it relates to subsidies, if you were to look at a map of where a lot of these clean factories were built over the last 4 or 5 years, or where they're expected to be built going through the end of the decade, there's really a belt that's actually started to develop between Michigan all the way to down to Georgia. And some refer to it as a battery belt. There's other industries like solar and wind manufacturing in there. A lot of those states are in deep Republican states, and we would expect that representatives and senators from those states wouldn't be so quick to give up the subsidies that are supporting their local economies.
That's a great point. And I'm glad you mentioned the word mining, because I want to talk a little bit about the equity side, the miners themselves. You know, we so often talk about physical copper, physical uranium, physical gold, physical silver, and sometimes I think the miners get overlooked. Certainly from a performance standpoint, historically that's been the case for the last decade or so, but that seems to be changing also. So Ryan, let's go back to you for a minute and talk about the miners for a second. How should investors be thinking about not just gold and silver from a diversification standpoint, but from an opportunistic standpoint? How should they think about the mining stocks?
And so from the equity standpoint, typically what we're looking for when you're getting to that area is we're looking at more of a tactical allocation of anywhere between 0 and 5%. And we think of it like any other sector that you'd think about, and you try to take advantages of the cycles. And so when things are, out of favor, on the gold equity side or silver equity side, when they're losing money, when they can't raise money, projects aren't proceeding, maybe supply is stagnating or dropping, those are situations where you really want to get involved and probably allocate to the full 5%.
Okay.
And really take advantage of those cycles. Because when you do that, what you're actually getting, in addition to just exposure to gold or silver, but you're also getting torque to the metal price through the operational leverage from the firm itself, in a couple different ways. So for one, if you were to expect gold price to increase by 10%, we'd expect the profitability of the average gold or silver mining company to increase by about twice that, so about 20%. And so that's one aspect of it. And then when you also get the gold price increase, you also tend to get increases in reserves, resources. Maybe there's some opportunities for expansions or new project development that wasn't anticipated at lower gold price as well. So you actually do get some value-added pieces as well to the equation. And so, really gold mining equities and silver equities provide a little bit of torque, but they do have a little more risk as well in terms of they're more volatile than the physical commodity itself.
Okay. And Steve, I got to believe that's similar as it relates to copper mining companies, uranium mining companies, but anything that maybe stands out that's slightly different in that side of the equation that would stand out from a gold and silver mining stock?
Yeah, that's correct. You do expect to see that torque as it relates to the miners relative to the underlying commodity. I think one sense where it's different versus maybe a gold and silver allocation is that we do tend to see investors allocate to the critical mineral space in the growth sleeve of their portfolio. A lot of, particularly as it relates to uranium miners, a lot of portfolios are underweight if they have any exposure to uranium and mining at all. So those are investors that we see typically allocate to the growth sleeve. There's also an argument to be made to add it to the energy sleeve as we're diversifying energy sources away from your typical oil and gas type companies. We don't necessarily see in those type of sector allocations exposure to uranium. Copper is more and more becoming not only a base metal and its use for within technology and conducting electricity, it's also being used in more forms of energy as it relates to wind farms, solar panels, and EVs. So that growth allocation is a spot where we're seeing, I'd say, a lot of investors looking to slot that exposure.
Well, and I appreciate you bringing that up also, because that's an important distinction of how should investors and advisors slot these allocations within their portfolio. I know, Ryan, you said kind of in the bond part of your portfolio on the physical side. The equities would be more on the opportunistic side, I'm assuming, and the same would be true for copper and uranium. Would you put that on the diversification side, or would you put that on the energy side as well?
I think it could have that dual role, right?
Okay.
So it does provide diversification in your portfolio, and given the volatility and the expected growth in the critical materials space, we do see people add that to their the growth sleeve as well. So I think it can fit both as a diversification and also as a growth sleeve as well.
Okay, now this is a dual question coming up. This is silver. So silver historically has kind of lived within the gold, precious metals category, but that seems to be changing a bit. And so I'm going to start with you, Ryan, first. And what have you seen over the last decade as silver has matured? Is it finally stepping out of gold's shadow, or does it sort of still kind of live in that environment or that neighborhood?
Yeah, I think it'll always live to some extent in part of gold's shadow, just because gold is viewed primarily as a monetary element, and silver's got the monetary element as well, but it also has an industrial component in terms of a lot of industrial uses, particularly around electronics and so forth. And so, silver I think does have a great duality to it, and it also attracts a different group of people as well, as you'd expect. And what's interesting about silver is the people that it attracts actually tend to be more economically sensitive to changes in its price. And so as a consequence, if you expect gold to do really well, you'd probably expect silver to do even better to some extent, just because you tend to get more people coming in to get the extra torque to the gold price. But then there's also the economic sensitivity around the industrial side of that commodity as well. And you've seen huge deficits in that commodity over the past several years to the tune of kind of anywhere from 15 to 20% of supply, which are huge. And so from that standpoint, I think there's a lot to be had there as well.
And Steve, can you add to that, as you really spend a lot of time on the critical material side, is silver coming up more and more in conversations as we talk about this energy transition, as we talk about critical material? Are more people, more investors looking at silver as a critical material?
They are, right? It does have that dual role as a precious metal, industrial metal, as Ryan was saying. As it relates to the critical materials space, it's being increasingly used as it relates to the photovoltaics with solar panels. So basically, once the solar panels are being produced, there's a silver paste that can get applied to the solar panel, and that will be used to send the electricity throughout the grid. A lot of people don't necessarily, I think, appreciate that. One, silver's the most conductive metal that we have out there, even more so than copper. It's generally cost prohibitive to use in the same way that copper is. And then second, if you were to go back a few years ago, you would see somewhere around 8, maybe 10% of silver that was mined would be used for solar panels. We're starting to see that percentage increase higher. Now we're around 16 or 18% or so of the silver that's being produced is expected to be used for solar panels.
And I want to stay on that for a moment, which is the old supply and demand. It seems like the theme here is really supply and demand. We need more of it. We don't have enough of it. What have you seen in the last, say, 5 years or so change as it relates to supply and demand? I think, Ryan, you said it earlier with President Trump, or President-elect Trump coming into office, maybe being a little bit more supportive of drilling and so forth here in the States. Do you see that supporting the supply-demand dynamics, and how long do you think that will take to catch up from a pricing standpoint?
Yeah, so I guess there's two parts to the demand and the supply side. So the demand side, I think it's pretty obvious that Trump would like to see the economy grow as fast as possible when he's in his presidency. And so I think from that standpoint, I think he will do a lot to release the regulations, whether it's drilling in terms of finding new exploration deposits and so forth. I do think he will try to take down some of the permitting aspects of it to a more manageable timeline.
Not to cut you off, but what are those timelines right now, just to give a sense for people what we're actually talking about?
Yeah, so right now to permit a mine, generally speaking, takes about 15 to 20 years, depending on where you are in the world. And so it actually causes a lot of the cyclicality in the space to a degree, because if you look at it from a supply side perspective, its inability to quickly respond to changes in demand is difficult, right? So they can't just start producing more, or even, frankly, if there's oversupply, start descaling the mines or shutting them down. It's very tough to influence things higher or lower very quickly. And so that's, again, one of the things you can take advantage of in the investment side when we're talking about materials, whether it's the precious metal side or the other critical materials. But from the supply side, I would definitely expect some inroads to be made that way. But on the other hand, it still takes a long time to build a mine. Right. And so that's not going to happen tomorrow either.
Well, I have to believe that's the same for copper and uranium mines, but also, the demand side for particularly uranium, let's talk about that for a moment, has been relatively quiet until recently. Copper, we've always needed copper. We're going to continue to need copper. What has changed in that, and what does that look like from a landscape standpoint as supply is trying to catch up with demand? Can you talk about time frame? What are we talking about here?
Yeah, so again, we take a longer term view in the way that we look at the critical materials opportunity. If you were to go back over the last 15 years or so, we really did have a lost decade as it relates to investing, particularly in uranium miners. We were able to get away with that because we did have these large secondary stockpiles that had been built up over time, so utilities could draw on those stockpiles. Several years ago, we started to deplete those stockpiles, and now we're at a point now where we're not producing enough uranium to offset how much is going to be required by utilities. So we have many utilities, not so much in the United States yet, which tend to be lagging in this space, but they're starting to secure the uranium supplies over the next 3 to 5 years or so. If you were to look at China, they're actually the only country that's really stockpiling uranium in any sort of meaningful way. The United States utilities haven't really gotten there yet. They're a little bit behind the 8 ball. So what this is going to cause, one is, in our view, there's going to be this catch up where we're going to see Western utilities and try to catch up and source more uranium. At the same time, we're also contending with these long lead times to get a new mine operational. From a uranium perspective, if you were to go out through about 2040, there's an estimate that we'll be have a cumulative deficit of uranium to meet our needs, both now and what's expected from growth between then, of somewhere around 1 billion up to 2 billion pounds, depending on what your estimate is as far as net zero and small modular reactors and advances in technology as it relates to reactors. On the copper side, we actually have a somewhat different story, where right around that parity part where we have demand meeting supply. We expect over the next coming decades that we would see supply fail to keep up with demand. A large part of this is, one, again, it's getting those new mines up and running. Copper mines on average take about 16 and a half years to get up and running from discovery to producing. But the interesting thing about the copper market is that it's very much in a position now where, as you said earlier, it's a very common metal. We've mined all the easy copper at this point. So miners are having to dig deeper, go more remote. That requires infrastructure to be built out to get these mines from more remote locations. So since all that easy copper is mined, we're going to need more investment into the copper space. We're also going to need to see the permitting timelines come down. And another factor that we have as it relates to copper is a lot of the copper is mined in countries that are prone to social unrest. So we see that in Panama, where we had one of the larger, the Cobre Panama copper mine, come offline because of social issues, as that relates to how much the copper miner is paying back to the government on their royalty. So hopefully that's a mine that they'll get that worked out and figured out. But we still do have this overhang of needing to find more copper and needing it to be in a meaningful supply to meet demand.
So it sounds to me that it's really a multi-market cycle opportunity, both on the gold and silver front as it relates to supply and demand, and certainly on the copper and uranium front. This is not one market cycle opportunity. This seems like it's multi-market cycle, multi-decade opportunity from an investment standpoint.
Yeah, and I think you also have climate change in there as well. You've seen increasing incidents due to climate change that are preventing mines from producing or halting them temporarily. And so, to me, that's a huge factor. That's a huge tailwind as well for pricing in the sector. So you've got obviously yields kind of going down. So the intensity required for each new pound of copper or ounce of gold or ounce of silver is going up. And then you also have climate change as well. So those are two big tailwinds that you've got for the space.
So you basically have to do more to get less.
You got it.
So the price has to go higher.
Absolutely.
Not that we're promising, but we're just saying that's the opportunity. I want to go back in time a little bit, talk about history for a moment, because I think for a newer investor going into this space, having a historical reference to what's happened in the last couple decades might be important. So in the early 70s, from the early 70s, we saw several bull and bear markets, specifically as it relates to gold, and I guess as a byproduct, silver as well. Can you talk about the environment we were in the 90s, bear market, and the 2000s bull market, and compare that to kind of where we are now in the cycle?
Yes. So I'll start off in terms of gold, in terms of 1971, because that's really the key moment for gold when it became basically liberated. So we went off the gold standard in the United States in 1971. Gold price was approximately $35 an ounce. And over the next decade, so throughout the 70s, you had significant inflation. You had political crises and uncertainty around the world. Oil crisis would probably be the one that stands out in most people's minds. And so you had rates and gold price go up significantly. So gold went up from $35 an ounce, and it peaked at around $850 an ounce in around 1980. And as a consequence, Volcker, obviously ended up raising rates significantly to try to encourage people to slow down on the inflation side and get their mentality into a different mindset than it was before. And so that took a while, but he was successful. And so over the preceding next 2 decades, so from 1980 through to 2000, you basically had sort of a steady decline of gold for the first decade, and then you had basically kind of level off and ended up being kind of just sub $300 an ounce in and around 2000. And then from that point on, gold took off for the next decade. So it went from about 2000 to about $1,800 an ounce. I think largely due, you had a few financial crises in there, but more importantly, I think you had a change in monetary behavior from a lot of the central banks around the world. And I think really what that's done is that's caused, I would say, a more loose feeling around the fiscal responsibility that governments have about the money that they print and create. And so I think from that standpoint, really elevated gold to that next level. And then from, I guess, 2011, where it kind of peaked at around that 1,800 level, you saw it decline down to about $1,200 an ounce or so temporarily at about 2015. And then again, ever since then, it's sort of gone back up, and we just touched off 2,800, and ever since the recent U.S. elections, backed off now to about 2,600. And again, I think one of the things that's been at the forefront of that is monetary extremism. And, I think what people are forgetting is that the governments are using the people's own money to spend. And I think people forget that. They view the government as a separate entity independent of themselves. But I think people should remember it's their own money, and being fiscally irresponsible as a government is probably going to come back to haunt us at some point. But as a great way to play that is the two monetary metals that we've been talking about, gold and silver, if you want some antidote to what the central banks have been doing and the governments on their fiscal side as well. And so we'll see how it goes, but those are two great ways to take advantage of that.
Awesome, thank you. And Steve, I know you touched on this briefly about uranium, and kind of there was a lot of supply. That's really all been consumed, and now we need to get new supply online. Same with copper. Talk a little bit more about copper, though. You touched on this about how copper has traditionally been tethered to the Chinese economy because they consume, correct me if I'm wrong, over 50% of all copper consumption comes out of China. That seems to be changing as well. So can you talk a little bit historically about how that came to be, and then where do you think we're going if you look forward on both supply and demand of copper and uranium?
Yeah, so starting with copper, if you were to look at a price graph of the price of copper, I think I mentioned earlier that around the turn of the century it was about $2,000 per ton. What you would see is a ramp up going through the industrialization of China in the early 2010s, and then we saw it kind of pull back a little bit. And today we're up around $9,200, $9,300 a ton, I believe, is where prices were this morning. The important thing to remember about copper is, and as we talked about, it's decoupling a little bit from the Chinese economy, is that if you were to plot it from 2000 out to where we are today, there are ebbs and flows in the price, but consistently it's been trending higher. And that's what we like to see in areas of the commodity market where we think we're into that bull phase. We do see those higher highs, and we're not seeing lower lows. We do see corrections, which we think are helpful, but the trend has been much higher. Similar to the uranium space, we saw the same thing going back to the early part of the 2010s. We saw the price of uranium peak around $140 a pound or so. From there, the commodities, that part of the commodity super cycle kind of pulled back. We saw prices come down to about $20 or $25 a pound. Recently, at the start of this year and over the last 4 or 5 years, we've seen prices really come back to where we topped out around $106. That's come down somewhat. We're now around that $77, $78 a pound. Again, we view that as a healthy correction. A lot of the uranium transactions that we see don't take place in the spot market. So when we look at the prices that the uranium miners are actually contracting out, we're starting to see contracting prices in that on the upper side, the $120 to $130 a pound. So that would suggest to us that the uranium market, uranium prices are continuing to move higher, and that's something we foresee going into the next decades with healthy corrections throughout.
And that would be what you referred to as sort of spot market and term market. Just for those that maybe don't understand that part of the ecosystem, can you talk a little bit about the term market a little further? What's taking shape in there right now? What are these energy companies looking to do?
Yeah, so the easiest way to understand the term market is to think of what the spot market is. So the spot market is if you wanted to go out and buy uranium today, that's the current spot price. When these uranium miners and utilities are entering into offtake agreements where the utilities are buying material from the miners, they'll go into the contract market. And typically what they'll do, they'll buy material, it could be a year in advance, 2, 3, 4, up to 5 years or even longer in advance that they're looking to secure material. With that, there's usually a cap and a floor. What we're seeing with the caps, they're now up around $120, $130 in some cases per pound. Floors are above what we're seeing in the current spot market. And there's this kind of push and pull that we're seeing now where the miners understand where prices are moving. And in our opinion, a lot of the U.S. utilities are a little bit behind the eight ball in securing that future supply. They're looking at the spot price and saying, well, if the spot price is around $80, why are you having an upper level in your contract price at $130?
Okay.
So we think at some point we're going to see these U.S. utilities are going to have to enter the market, and that's going to be supportive of higher prices, both in the spot and term market. What we really see in the spot market is occasionally we'll see miners that maybe they didn't get the amount of uranium out of the ground that they needed to fulfill their contracted prices. Sometimes they'll come into the spot market and buy material so they have that for delivery. But what we're seeing is that contracting is really where the significant price moves are happening at the moment.
Okay, great. Thank you. And I'd like to kind of start to bring it to a close a bit and really talk about both gold and silver and copper and uranium as a pure investment. I think so often people have seen all these metals from a consumer standpoint. I consume copper in my home, and maybe I participate in uranium through how I pay for my energy, and gold and silver typically from a jewelry standpoint potentially. So consumers maybe know these metals, but they haven't really maybe thought of them as investments. So maybe circle back for a moment and let's close out with talking about a way to think about both gold and silver purely from an investment standpoint, whether you're a direct investor or an advisor.
So if you actually look at gold price since it's gone off the gold standard in 1971, it's compounded at about 8% a year, which to me is a very good return considering the properties that it has. And some of the unique properties that gold has is that it really adds a lot of diversification to one's portfolio, given that it's really uncorrelated with a lot of the other asset classes that people typically invest in. And so it's actually a real enhancer on the risk-return spectrum for people's portfolios. And so when things are doing really well in your portfolio, it could be that gold might be a slight offset or vice versa, which is really handy so you don't get these extreme moves in your portfolio. So that's typically a great thing to have. And the second aspect, just gold volatility alone actually is much lower than most other asset classes, which people are surprised to hear. People often think about commodities and how cyclical they are and the dramatic moves. But gold's a bit unique in the sense that it actually has much lower volatility than a lot of the other asset classes, whether it's U.S. equities, international or emerging market equities. It's a very good lower volatility play in that regard. And then silver brings in the industrial component as well. So it's got similar monetary components as gold has, but then it has the industrial side as well. So it moves a little bit more with the economic cycle of the economy. And so as you expect, you get more volatility with silver.
Great, thank you. And Steve, again, similar question. And speaking to the advisor or the direct investor, I know we already talked a little bit about this as far as how to think about both copper and uranium. But as you're looking to allocate dollars to this space, what would you like to leave the investors with or the advisors with when they're allocating capital for their investors? What would you like to leave them with as they think about these assets?
Yeah, so I think the first thing is that we provide through our ETF lineup is optionality. So we have 7 critical materials ETFs. We have a broader based SETM, which is kind of our broad-based product. It provides exposure to up to 9 different critical materials. That's one where investors that might not fully have a view on one material over the other might look to allocate to SETM. From there, we allow investors to really take a targeted approach. We have LITP, which is our Sprott lithium miners ETF. Provides pure play exposure to lithium miners. And one of the differences in our lithium product versus others you might see out there is that we don't have those downstream exposures that you would see. There's no EVs in our lithium product. It's all mining and production based. We also have, as it relates to nickel, which is the only nickel miners ETF on the market, ticker NIKL. And then as it relates to the copper side, we have 2 copper ETFs, COPP, which is our all cap copper product, and then also COPJ, which allows investors, it's the only ETF actually to allow investors to make a view based on junior mining companies in the copper space. And then as it relates to uranium, again, we have ticker URNM, which is Sprott Uranium Miners ETF, ticker URNJ, which is our junior miners ETF, which targets just those junior uranium mining companies. Again, that's the only ETF of its kind. What these all have in common is that they all have pure play targeted exposure. right? So we go through great pains when developing a product to go through with the index providers to really come up with a process that is really targeting those companies that get at least 50% of their revenue or assets from the underlying commodity. And so as investors are looking to make decisions, what we want to do is provide funds that in copper, as an example, that if you want to make a decision on investing in copper, you know you're investing in copper miners.
Okay.
One of the things that often gets lost in this space is, and copper is a great example of this, if you look at the 10 largest copper miners in the world, only 4 of those are actually publicly traded and majority copper companies. So only those 4 would be eligible in our COPP index, whereas other funds might have copper miners where maybe only 15 or 20% of the exposure is related to mining copper. So that's kind of the key differentiator amongst our products as it relates across the suite. So as investors are looking to make those tactical allocations into the growth sleeve or energy sleeve, that's the point that we would have that conversation and talk through what pure play means and why that's beneficial. Because typically what we do see is over longer terms that the stocks outperform on the upside. Now you will expect underperformance on the downside. So as the spot market's moving down, you would expect that underperformance. But it does give that level of leverage that we talked about earlier, and we think that plays well across growth sleeves in many investor portfolios.
So Ryan, let's go back to an advisor's way to allocate to the space or an investor's way to allocate to the space. What are some of the ways at Sprott you guys can give clients exposure to both the physical market and the equity market?
Well, the great part about Sprott is that we've got really products for every aspect of the natural resources space. And as it relates to precious metals, on the physical side, we've got 2 great products. We have symbol PHYS, which is our physical gold trust, and we have PSLV, which is our physical silver trust. And the great thing about those 2 products is that they're completely allocated physical material, so physical gold, physical silver that's allocated to us. And we charge a very low fee for that as well. And so it really is cost effective in terms of owning physical gold and silver versus storing it at home, which actually is hard to get insurance on physical gold and silver at home. So it's a very easy way and effective way to do it. And the other aspect is from the gold mining perspective and silver mining perspective.
So how about on the equity side? How can you get allocation to the equity side?
So on the equity side, we've got a couple different ways. So we've got a mutual fund called the Sprott Gold Equity Mutual Fund, and the other one is the Sprott Gold Miners ETF. And so there's an active approach with our mutual fund. We've got a great team who's executing on that. But if you also want a passive approach, using a factors-based approach, which is what we use, I would recommend our ETF as well, SGDM.
And let's go back to the physical side for a moment. You talked about being fully allocated, owning the precious metals. Why in your mind is that important relative to getting exposure in the general market?
Well, I think 2 things. So I guess you wouldn't like to get exposure to anything you didn't think was going to get a good return over time. And the second part of that is diversification. So it really optimizes your risk-return allocation for your portfolio by you're either trying to enhance return while lowering risk. So it really is a nice addition to the portfolio. And to me, one of the things that really helps people over time stay invested and stay the course of their long-term strategy is to really have a portfolio that's sort of an all-weather portfolio. And adding gold into the mix, to me, dampens the volatility, and it probably helps people's psyche in terms of staying the course, in terms of maintaining their investment program.
And to go back to the miners for a moment, people are used to thinking about equities as large cap, liquid equities, and more opportunistic small cap equities. In the mining world, we call them seniors and juniors. Can you talk a bit about their personalities, what a senior miner looks like, without naming names, and what a junior miner looks like, and then talk about the respective opportunities in both, where you see potential opportunities as an equity investor?
Sure. Well, I guess I'll start with the whole spectrum of investing in the gold sector. So the least volatile, least risky is physical gold. And then you start moving into the mining categories where you start introducing a little bit more risk. And so it really goes the spectrum from the largest senior producers who are established gold producing companies, good balance sheets, good access to capital, good engineering teams, so forth. And then you go all the way down to the junior end of the scale, which is the much more risky end of the scale, but also an area where you can add a lot of value through exploration or development. And so really, I would say a lot of the key value add in this space is either on finding a new discovery or enhancing a discovery, so with exploration. And then it's really transitioning that exploration success to a producing asset through the development process. And that's the other category where they can add a lot of value, is actually developing an undeveloped mine into an actual mine. And so to me, I think it's actually good to have broad exposure across the categories, because you've got more stability, I would say, with the senior producers. But with the junior side, you often get value add in addition to the gold or silver price, whether it's a polymetallic metal mine. And so to me, having broad exposure across is probably the best allocation for that category.
Okay, great, thank you. And Steve, let's shift back to critical materials in general and talk a little bit about historically, even at Sprott, how the opportunity has really evolved over time, going from just simply electric vehicles all the way into globalization of the electric grid. Can you talk a bit about that and how that's really evolved and how investors should be looking at this opportunity longer term?
Yeah, and I can even go back a little further than that. I remember being in middle school in the 90s and looking and learning in my earth science class about solar-powered cars and how that was the way of the future.
Okay.
Where we sit today, we're not at solar-powered cars, but what we are at is solar power actually powering our cars. It's not on the car itself. So we do have EVs now that are very much involved in our daily life. But even if you just look at the last several years as the critical materials space is starting to mature, even though it's still in the early stages of what we believe to be a bull market, is you see, 5 or 6 years ago, a lot of it was aspirational. A lot of, we'd like to do this, we'd like to, have net zero carbon by 2050. Where we sit today, now we're starting to see those pledges that are signed by over 100 countries around the globe to decarbonize and have those net zero decarbonization pledges, many to 2050, some after that, some a little bit before. But what we've also seen is, as pledges can go, anybody can make a pledge. It's not worth the paper it's written on.
Right.
The investment that we're seeing come into that, if we just look at last year alone, BNEF, which is the Bloomberg New Energy Finance, estimates that there was about $1.8 trillion spent as it relates to the energy transition. We've seen significant growth over the last 5 or 6 years in that space, where 2 years ago, the investment in the energy transition space equaled that of fossil fuels, and now we're past that and expect that to be into the future. And even since we launched our lineup, we've seen a shift from critical materials and their role in the energy transition has really broadened now into, based on what we're seeing with the AI and storage facilities that we talked about earlier, is that we really need more electricity. It's not just about clean energy, it's about we need more energy.
Right.
So with that, we've actually seen a greater importance being placed not just on the energy transition, but we have to meet the energy needs of the globe now. Eastern countries and developing countries are requiring massive amounts of energy. And so I'd say that's probably been the biggest change that we've seen in the last several years is that mindset of it's all about the energy transition, and then also we're seeing that funding kind of come through and push us a little bit closer to those aspirational goals.
Well, and it seems to me also that I think the initial narrative was one versus the other, and I think you said this earlier that we really needed all of it. We need a base load, we need alternative energies, we need traditional energy sources. Anything on that horizon that you think from a technology standpoint may be changing? What should investors be looking at as they go forward, and what should they be paying attention to as it relates to critical materials?
Yeah, there's, and it really falls into that all the above approach is now
Okay.
you have oil companies which are actually mining lithium and experimenting with that because they do see the need of, and the potential for EVs and lithium extraction. That's a place where they're investing quite heavily in different ways to extract lithium. When you look at the nuclear energy space, where we're moving toward, away from these large nuclear reactors and toward smaller modular reactors that can be built off-site really and assembled maybe in a more remote location. They're much smaller, can be used for things like data centers. They can be used to, at one point, power mines, mining operations, and the infrastructure that goes along with that. So the ability to have these small modular reactors is getting a lot of attention, particularly in the United States. And I think that's why you don't see the United States announcing nuclear projects at the same rate that we see in China, for example, is because we're getting close to that technology becoming commercially viable, and that's really the path forward here, I believe, in the United States, is that modular reactor type approach. And one of the benefits to that is you could take an old coal plant, remove the infrastructure, and you put a modular reactor in its place, and now you're generating nuclear power, and you're you're using the infrastructure that was already in place to transmit that
Interesting.
energy. So that's where we're really starting to see as it relates to the generation side of power. Those are some of the changes that we're seeing over the next, call it, decade or so.
Yeah, that's what I was going to ask you. From an expectation standpoint, what is a realistic expectation of seeing small modular reactors actually become viable and actually enter the economy? What's kind of a time frame of that?
Yeah, and 2030 is a spot that most people will point to as that becoming a reality. And there's a lot of funding flowing into this space. Bill Gates is actually committing a lot of funding to the modular reactor design. We see Silicon Valley. We talked about data centers and how they're looking to use nuclear energy. They're very much in tune with what's going on in that space, and would likely be a user of that type of technology. But I think through the next decade or so is where we'll start to see those roll out and become more commonplace.
And not to throw water on aspirational targets like 2050, but from a realistic standpoint, we talk about supply-demand dynamics. How realistic are we going to get to a carbon neutral future by 2050? What needs to happen for that to actually even get close to happening?
I think you would have to upend world economies for that to happen, which might pose well for things like gold and silver. But you do have to have a goal to work toward, right? If 2050 is that goal, it's a nice round number that we can work toward those aspirational goals. That's great. I think the key thing is flexibility, right? We're understanding that we're in the early stages here, we believe, and technology is changing. The material that we're bringing out of the ground, the quantities that we need to have just to be able to reach those 2050 goals, it in and of itself is a huge lift. To give you a frame of reference, if you look at all the copper that we've ever mined before 2022, it would be about half of what we have to mine between 2022 and 2050.
And you say ever, you mean ever?
Ever.
Okay, so yeah, we got a ways to go then. So I think that just highlights the supply-demand dynamics and the long-term investment opportunity, both in copper and uranium, and as well in gold and silver as we continue to expand our economy, as more people are allocating capital in an invested portfolio. We talk about electricity, but we don't talk about, hey, as the economy grows, so does wealth, and people want to diversify their portfolio. It seems to me that both copper and uranium and gold and silver have a bright future.
Yeah, and I think just one last thing on the mining aspect, and as it relates to building infrastructure, a lot of mines are outside of population centers. They're fairly remote. Those types of operations will likely continue to use fossil fuels to power those operations. Though we're moving to there's a movement toward getting more solar power to power generators, or wind farms to power generators, and get some electric vehicles in there. It's in our view, fossil fuels aren't going away anytime soon. It's too ingrained in our economy.
Fantastic, thank you. And before we completely sign off, any last words of wisdom either one of you would like to leave the viewers with?
I would just say, having a diversified portfolio, I think now is probably more critical at this juncture. You've got, equity markets around the world at very high levels. Debt levels are broadly high, and you've got a lot of uncertainties, I would say. And, I think, things like gold and silver in particular will probably do very well on an absolute and relative basis. And so I think people should have exposure to both those in both the physical format and the equity format as well, given that surprisingly, despite gold and silver doing pretty well this year, they've really underperformed their profitability levels that they've shown. So we view that as a great opportunity.
Wonderful, thank you. And how about you, Steve?
Yeah, what I would say as it relates to critical materials, this is an investment space that's evolving. It's one that's growing and becoming more investable as the years go on. What I would caution investors is not to chase returns and not to feel discouraged about a longer term view. To expect volatility in their investment, we advocate a medium to long term investment horizon and time horizon when looking at a critical material space. And we think that the fundamentals of increased demand coupled with decreasing supply in many cases is beneficial for that longer term view.
Great. Well, Steve and Ryan, thank you so much for taking the time today to talk about both gold and silver and copper and uranium. For all of our viewers out there who'd like to learn more about Sprott, I encourage you to visit us on our website, which is sprott.com. That's sprott.com. And again, thank you for watching.